Hey traders, this is Blake Morrow with Traders Summit. With me today is I've got Mr. Jim Welsh from Macro Tides. As we always meet on Fridays, it's good to wrap up the week with you, Jim. How are you?
I'm doing good, Blake. How are you doing?
I'm doing great. I'm always happy that it's Friday, and it's always really nice to talk to you, especially with everything that's happening in the markets. And this is actually we've had some pretty interesting price action the last couple of days as we have come into the end of the month, especially in the currency market and also in equities as well. But that's not what I wanted to talk to you about right at this moment. Next week's a big week. We have the jobs report, for the month of October, but more importantly is we have the FOMC coming up on the 3rd, and you've had a lot of opinions about the Fed. So let's talk a little bit about what your expectations are going into this next week.
Well, as we've talked, as I've written, the Fed has lost credibility over the last 6 months progressively. Powell started its transitory inflation last March, and obviously that's just proven wrong. I think the Fed needs to do something to regain some of that lost credibility. The easiest way, Blake, would be for the Fed to do 20 billion a month in terms of the tapering versus 15 billion. It will have very limited impact on the economy. So there's not much downside. And I do think there would be upside, to restoring some measure of the Fed's credibility. If short of that, I think there'll be more hawkish tone in Powell's post-meeting press conference, and maybe in some of the language.
So do you think they're going to be a little bit more hawkish because of maybe some of the actions that we've seen in our neighboring central banks? Well, we have the Bank of Canada, we had Brazil this week, and obviously other central banks too, the ECB just yesterday. I mean, with all this other central bank activity sounding a little bit hawkish, you think the Fed's going to be a little bit more hawkish then?
I do. And again, it's warranted. Housing prices are up 20% year over year. We don't need no stinking, mortgage-backed security purchases. With inflation running hotter, and now the Fed has acknowledged it's going to be, and just the year over year comparisons, Blake, from last September, October, November, December, January, February, the takeaway values from last year for the core CPI is about 0.1. So every single month, the core comes in 0.2, 0.2. The core is going to keep climbing. And I think that's what's going to happen in the next few months. So the data isn't going to be kind, if you will, to the Fed. And I think one way they can kind of minimize or try to minimize the impact from that is to have a more hawkish tone. And it'd be obviously actions speak louder than words. And that's why I think it would be prudent for the Fed to go 20 billion instead of 15.
Well, okay. So let me ask you this then. I mean, what the talk of the town right now is what's happening with the yield curve and what's happening with like the shorter duration bond market. What do you think is going to happen to the market, especially if you're talking about bonds and yields? If you do see the Fed actually be a little bit more hawkish, is that going to be, I mean, how's that going to be viewed by the market? I mean, I would assume it's going to be pretty negative for risk assets, but what are your thoughts there?
Well, you think about what's happened in the last 3 to 6 months on a lot of different markets. What we would expect based on common sense is not always what we've gotten. In fact, we've gotten the opposite. Inflation has gone up much further than anybody expected. Gold didn't go up. Okay, that's weird. We've seen bond yields, especially long end, the spread between the 30 and 10 year continue to narrow from its peak last April, May, even though inflation's up. So, in other words, you would expect longer term rates to be rising faster than the 10 year. It's not happening. So I think the bond market would likely look at what the Fed is doing. And again, wanting to believe that, hey, they are going to be the inflation fighter. Inflation will be transitory. Yeah, granted, it'll be another 6 months. I think there's a chance that bond yields will dip a little bit more if they make, there'll be some volatility, but I just think there's the potential for bond yields to dip a little bit more before the upturn in yields resumes.
Okay, well, that's interesting to hear from you. So I want to turn your attention or the listeners' attention to the dollar, and you've been pretty. pretty vocal about the dollar, looking for a move down to 93. Friend, if I remember correctly, last week about this time we were around the 93.70, 93.80 level.
Right.
So we broke through some support this week following the ECB. You had the euro pop its head near 117. Saw a big reversal here on Friday at the time of filming. We're seeing the dollar reverse. So I have to say, good call, because you expected some lower dollar before higher. The dollar has reversed. I'm not sure if it's more end of month, or maybe people looked at the ECB and said, yeah, I don't believe whatever you're throwing at us, Christine Lagarde. What are your thoughts with the dollar here now that we're facing two major key events going into the next week? So what do you think?
I still favor more weakness in the dollar, Blake, before this correction is over. So I'm just looking for a little deeper pullback. Now, the dollar is one thing that potentially, if the Fed goes 20 instead of 15 billion on the taper,
I was going to say,
the dollar would benefit from that.
Sure. Okay.
So that's the caveat, because it's an unknown. So that would be my take. But, again, just looking at the chart, I think you had a wave A down. This little bounce is a B wave or something like that. And then I think there's more weakness to come. But it's going to be dicey because, again, the Fed, I believe, at a minimum, will have a more hawkish tone than they've had in quite a while.
Okay, so if I'm, because you say one thing about, the Fed, and if they are hawkish, then obviously the dollar is going to reap the benefits of that. But the flip side is the charts are telling you that there might be a little bit deeper pullback coming in the dollar before we get a rally. So, and to your point, you're not really sure, even though you feel that the Fed's going to be hawkish, you're not really too sure of that, right?
It can't be. I mean, again, this Fed has been extraordinarily dovish. All right. And the two people, Rosengren and Kaplan, that are leaving are more hawkish. So when they reappoint two new people, they're going to be certainly more dovish too. But in terms of this meeting, we know what the history has been. So it's a little maybe nuts to say, I think that might go 20 instead of 15. The other issue is very simple. The recent highs in the dollar over the last 2-3 weeks, if you get a couple day closes above those highs, then I think, the correction's over. We're going higher. And as you and I have talked, and over the last few months, I have expected the dollar to go from the lows it made in late May, June, potentially over the next year up to 100. So, all this little jockeying for position, if you will, is in the context of, I do believe the major trend is up. Getting much below 91.50 would call that into question. So that's my framework, longer term, and then obviously the very short term as well.
All right, very good. And I'm going to ask you one last thing. Let's touch a little bit on gold. Gold, once again, this week we're struggling around the 1800 level. Here we are at the end of the week, another Friday slide in price. Do you make anything of it? If I'm a gold bull, should I be worried? What are your thoughts here?
Well, it's always frustrating because, as you know, when gold was down below 1730, I thought it was a buy. I thought it would at least rally toward 1800, which it did. It has pulled back. There's a trend line going back to May of 2019, Blake, on the dollar, on gold. And what we've come is we broke below it, got above it, broke below it, and now we're trying to get back above it, and it keeps trying and then falling back. That line's around 1815. I still think the odds favor it getting above that line, and if it does, we're going to see a spurt to at least 1835. That's the big time overhead resistance. So I think in my last letter, it was like, hey, there's a pullback possibly coming here off of this line. I believe the stop I recommended was 1760, something like that. So as long as there's a trend line underneath the rally, the higher lows that we've been hitting. So wherever that trend line comes in at any given day, that to me is important that we hold above. You take that line up, then I think gold bulls, I would become much more cautious and less optimistic.
Great. All right. Well, Jim, any last things or any last thoughts that you have for the traders going into this next week that they should be looking at that we didn't touch upon?
Right. Well, as you know, back on the 21st of October, I said this time, I think bond yields are going to come down. I have to admit, I'm a little shocked by how much they've come down in such a compressed period of time. And I'm kind of respectful that there could be a little bit more yet to come before the major trend. I still believe Treasury yields are going above 175 on the 10-year. But there are a lot of short positions in the Treasury market because it seems like an obvious trade. Higher inflation, yields should go up. The Fed's going to become less accommodative. And so there's a lot of shorts. And I think this rally in bond prices is squeezing a lot of those shorts out, and it could have a little bit further to run. In terms of the market, the market is carried further than I expected, but I'm getting more and more signs on the momentum work that I do, Blake, that we're nearing a high in the S&P, and I still believe there's a pullback coming. The breadth numbers have started to compress and so forth. So I think that pullback is still on its way. And obviously, if the Fed does 20 instead of 15, or even adopts a more hawkish tone, I think the bond market will be more comfortable with that than the equity market. And we are seeing more companies talk about supply chain disruptions. And the companies that have talked about the supply chain stuff, Blake, their stocks have been underperforming. So I think the market is finally starting to get sensitive to it. And if Apple can't get enough parts with their muscle, this is a problem. And Tim Cook actually said the computer chip thing could last into early next year. So these problems are going to persist. And then it's just a question of how much is that going to hurt sales, obviously earnings, and impact GDP. So a lot of people are looking at the GDP report and I think jumping to a wrong conclusion. It's like, oh my, look at how far it dropped. But a big chunk of that is because people can't buy cars, can't buy shoes and apparel, toys. There's a lot of things you just can't get right now. People certainly have the money. There's almost $2 trillion of excess savings. So I'm not worried about the economy because I think consumers will have the wherewithal and they will continue to spend as products become available. So that is a bigger picture in terms of my outlook, if you will, for the overall economy.
Well, Jim, thank you so much for your thoughts. We do appreciate it. Remember, folks, if you like what Jim is doing with you every Friday, make sure you give him a thumbs up on this video. If you're watching us on YouTube, subscribe to the channel. It's free to actually subscribe to the channel so you don't miss any of his interviews that we do every week and other traders and analysts that we bring on here on Trader Summit. Jim, I want to thank you so much for spending your time, very valuable time with us this Friday, and good luck this next week.
Thanks. You too, Blake. Have a great weekend.
Thanks. It should be a good one. All right, Jim, we'll catch you soon.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.